Things are looking rather dark as we get set to close out the week. There was a time when the market wasn't bothered by the darkness, easily shrugging it off on account of central bank induced incentive designed to make it so. The trouble is that incentive is no longer there, and as per that thing called the law of gravity, what goes up must come down, or perhaps more appropriately, in this case, the bigger they are, the harder they fall. The thought of any downside risks to the global economy impacting global markets for more than a moment, including geopolitical risk, was an absurd thought. The authorities that be would always have investors' backs. For 10 years, the voice that kept ringing through was a voice that said, "Don't worry about it, just keep going." But now that voice is no longer there, and all of those downside risks become a whole lot scarier, with the market no longer immune to such risk and needing to think about contending with it on its own 2 feet. And over the past several days, we've seen what those feet have been doing, running for the exit door. The combination of monetary policy normalizations, and even if these normalizations are forced to slow up because of the sentiment downturn, we can say the combination of exhausted policy accommodation at a time when investors are staring at global trade risk, Brexit risk, Eurozone structural risk, and emerging market risk is a combination that makes it difficult to see a rosy path forward, at least over the coming months. It's important to remember that irrespective of any downside risk from a cyclical technical perspective alone, the U.S. equity market has run too far and fast and is well overdue for a correction that could easily extend another 20% from current levels, and all with it being a normal correction within a longer-term uptrend. The point here is that a 30% decline off the record high in the S&P 500 would take us back to levels not too long ago, only back in 2015 when the market was making record highs and had been making them for 2 years. All of this is at the center of everything right now and is clearly rippling into other markets. As far as currencies go, one would expect risk-correlated FX to have been hit the hardest over the past week, and yet it's the euro and pound that get that prize. Both of the major currencies are contending with risk that has driven the relative weakness. However, if things keep up, we anticipate the intensification of risk off to start to prop these major currencies again. The 2 points that need to be considered going forward right now are the impact of U.S. trade policy on the FX market. Remember, this is a trade policy committed to weakening the U.S. dollar, and the possibility that the Fed is forced to make some kind of a gesture to the market that it might need to scale back on the normalization in light of the downside risk. While we don't expect this will do too much to prevent the equity market from declining to where it needs to in order to flush out all of that artificial support over the past decade, we do believe it could trigger a scenario where the US dollar is sold once again. Looking at today's calendar, the focus will be on these bigger ticket risks out there, while we also get some important US readings in the form of GDP, core PCE, and Michigan sentiment. That's all for now.